Good evening, Canada. Welcome to week 6 of the Investor's Guide to Thriving, Fall 2021 edition. Well, if you're a huge nerd like me, tonight's show's going to be a lot of fun. Even if you're not, you just like investing in the bleeding edge of what's driving growth in the economy. It's still going to be fascinating. Before we get going, I'd like to take a minute to acknowledge the sponsors and supporters of the Investor's Guide to Thriving, which are BMO ETFs, our partners in ETF education since 2009, and our group of companies, which includes ETF Capital Management, where Larry manages ETFs and funds of ETFs in partnership with BMO. And we work directly with clients on portfolios of $1 million plus. You can learn more at etfcm.com. Investor's Guide to Thriving is also in support of the research efforts at Sick Kids to find better cures for childhood leukemia, and the Baycrest Foundation, where we support their world-leading Alzheimer's and dementia research efforts. If you would like us to match your donations, please use the links in the survey that you'll receive after the event, or visit investorsguidetothriving.com and use the links there. That's how we're able to track and match your generosity. Well, coming back to the agenda for tonight, we're going to be talking about innovative technology, fintech, robotics, genomics, autonomous vehicles, AI, and more. Tech has always been the driving force behind change in the world. Technology has been thought of as a series of revolutions. The first industrial revolution began in about 1765 through the end of the 18th century, and this was the era of coal power, mechanization, and the invention of the steam engine. A century later, the second industrial revolution was powered by new forms of energy at the time: electricity, gas, and oil, the internal combustion engine, and eventually the automobile. Steel production spiked, and advances in chemical synthesis fueled massive innovation. We then saw the telephone revolutionize communications, and these technologies powered us into the 20th century. Television, the third industrial revolution, computers, space travel, new levels of automation, then the internet, now the fourth industrial revolution, which many believe will be about AI, machine learning, virtual reality, and blockchain. One of my favorite futurists, Jason Silva, called technology a parallel force of evolution. And technologist Roy Amara famously said, "We tend to overestimate the effect of a technology in the short run and underestimate its effect in the long run." Here tonight to help you not underestimate technology's role in your portfolio, Larry Berman and Danielle Nezel, Vice President of Online Distribution with BMO ETFs, will be featuring an interview with Kathy Wood and all kinds of insights about how you can participate in the technologies that are reshaping our world and our lives. Larry, over to you.
Thanks very much, Jared, and welcome, Danielle. Very excited to do this segment with you tonight. Having seen this video that you did with Kathy several times already, and taking notes, copious amount of notes in preparation for tonight's presentation, I'm really excited to dig into this topic with you. And as Jared said at the outset, this is a whole new area for old dinosaurs like me who think about discounted cash flows and how to invest. This is going to be an interesting conversation because half of these companies don't make any money yet.
Yeah, thanks, Larry. So great to be here. I'm so excited to talk to you about innovation. I'm excited to show you and everybody else my conversation with Kathy. She's a wealth of knowledge. I've learned so much from her and the analysts at ARC, so I'm excited to share that with everyone tonight.
Yeah, a big part of it is drilling into a lot of the research and stuff that you've learned in the last couple of years in dealing with the ARC analysts themselves directly. So very excited to get into that. But first, as a primer, as an opener to our presentation tonight, let's get into the video.
Hi, I'm Danielle from BMO ETFs. We are so excited to be here to talk about investing in the right side of change, and that's investing in innovations with BMO's Innovation ETFs. At BMO, we recently launched 4 single-theme innovation ETFs, which cover the 4 major platforms: genomics, fintech, autonomous technology, and next-generation internet. We're also thrilled to bring to market our BMO MSCI Innovation ETF, which combines all 4 of those innovation platforms in a single ticker. And all of our innovation ETFs, of course, track the MSCI Innovation Indexes, which have been developed in collaboration with ARK Invest. We have Kathy Wood from ARK Invest with us today. I can think of no better person to set the stage for us on innovations and speak to us about the 4 major innovation platforms. Kathy is perhaps the most popular innovation investor and a leader in the space. And Christine Berg, Managing Director from MSCI, is joining us as well to talk about the MSCI Innovation Indexes, which BMO's innovation ETFs are tracking. So Kathy, thanks so much for being here today with us to talk about investing in innovations.
I'm really happy to be here, Danielle. This is an exciting day for innovation, I would say.
And such an exciting topic. So Kathy, maybe we'll start. Can you give us some background to the ARK story and describe how you and your firm are identifying these disruptive innovation platforms?
Sure. Well, I founded ARK in 2014 to focus exclusively on disruptive innovation. The second reason I founded ARK was to create an open source research ecosystem and add new dimensions to research thanks to new technologies out there. And what we were seeing was an unmet need open up, a void in the public equity markets for innovation-related stocks. And the reason for that is, indexes are where they are, and the stocks within those indexes are where they are because of past successes. But we have innovation platforms evolving now. DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology that we believe are going to transform the world completely. So they're very forward-looking, they're not backwards-looking. And the only way they'll be able to scale and grow exponentially is if they're funded and supported by the public equity markets.
So you've said artificial intelligence will absolutely transform all sectors in the economy, even those impervious to disruption. Can you explain or elaborate on that thought?
Sure. I think the most provocative example today is healthcare. And it's provocative for a few reasons. Most healthcare analysts, historically, have not been comfortable with technology. It moves too fast and it tends to rub regulators perhaps the wrong way too soon. And then on the other side, you have technology analysts who are not comfortable with healthcare, right? Well, guess what? They're going to have to get used to each other because the convergence between and among DNA sequencing, artificial intelligence, and the new gene therapies, gene editing technologies, that conversion is going to be explosive. And if analysts and investors do not understand that, they're going to miss, I believe, some of the biggest healthcare related opportunities, agriculture related opportunities that we have ever seen. And so we're seeing another example of artificial intelligence entering a space that no one thought possible. And that's the transportation space. So artificial intelligence is going to be critical to the autonomous taxi networks and the autonomous truck platoons and the parcel and passenger drones that we expect to evolve very rapidly during the next 5 to 10 years. Could not happen without artificial intelligence.
So when we talk about disruptive innovations completely changing our lives, I think there's no greater example than genomic innovations. And you've said that you believe the most inefficiently priced and underappreciated part of the market is genomics, and the most misunderstood is healthcare. And I've also heard you quoted as saying you believe genomic stocks will be the next FANG stocks. So do you still believe this, and what do you find so fascinating about the genomic revolution?
For the first time in history, now that we understand the human genome, we can sequence your genome and we can figure out what in your genome is mutating. Now think about this. We have 6 billion pieces of code in our genomes. We couldn't find mutations before. Now that DNA sequencing costs have dropped below 1,000, we think we're getting close to $500 now. And within 5 years, $100, or if you want long read sequencing, then $250. You know, nothing compared to the $2.3 billion it took to sequence one person's genome in 2003. That's how far we've come. Now that we can find the mutations, we can use new technologies like gene editing to reprogram the genome, edit that mutation out. A mutation is nothing more than a programming error. We're going to be able to edit it out. There are now trials evolving for diabetes, which we spend more money in this country on and around the repercussions of diabetes. So that is going to be a grand slam. The reason no one thinks about cures is they've never happened before. We haven't been able to do this. And I still find it shocking that the 3 companies in the world with the foundational patents for CRISPR-Cas9, the 3 of them collectively that are starting to cure diseases, and we're seeing that, account for less than $25 billion in market cap. Now think about this. Apple, $2 trillion. These 3 companies, $25 billion. Now, Apple has transformed the world and it wants to get involved in healthcare, but it is not going to cure disease the way that these companies are, and they'll get royalties on every therapy developed with their technologies.
Let's move to the internet. So this is probably the largest innovation that we've all witnessed in our lifetimes play out over the past several decades. Kathy, where do you see the internet going from here? Will the next generation of the internet be just as impactful as the first? And will those FANG stocks continue to dominate and be the beneficiaries of this growth? Or do you think there'll be a new cohort of companies that will emerge?
Well, we do believe that the FANGs will continue to do well in here. Now, what we see evolving through the internet right now, and because of the internet, is really artificial intelligence taking over. It's software 2.0. And I believe today in the market, the global marketplace, artificial intelligence related companies account for roughly $2 trillion in market cap. We believe that number is going to $30 trillion in the next 10 years. Think about that. The overall market, I'm a little bit out of touch with the overall numbers, but they're roughly $100 to $125 trillion in market cap globally today. Here's how we see AI moving the needle: 2 to 30 trillion. That's a 15-fold increase. That would be a 17% compound annual rate of return. The strongest growth taking place near term, so much higher than that right now. In fact, there's a land grab out there because the companies who embrace artificial intelligence and collect the highest quality data and the largest pools of data are going to be set up for winner take most opportunities. And it is because of AI. The traditional internet, we see over the same 10 years slowing down to roughly a 5% compound annual rate of growth. Faster short term because we're just now seeing television advertising starting to plummet. And the move onto these new advertising platforms. But we do believe once that swoosh takes place, that the FANG stocks will be rather mature companies. And as we said before, we're looking for the next FANGs.
So now maybe let's pivot and talk a little bit about fintech. What types of companies will be the beneficiaries of advancements in fintech? Will it be the big banks, financial institutions, or do you think some smaller players like tech firms who are acting right now as disruptors in the space?
But what we're seeing in the United States, for example, and I do think this will happen throughout the world, is the rise of digital wallets. Now, China was well ahead of us, and Asia generally well ahead of us. WeChat Pay and Alipay have hundreds of millions of people basically using them for their day-to-day banking needs, a branch bank in their pockets or their pocketbooks or handbags. And they've scaled enormously. We're just now starting in the United States. The two best examples are Venmo, owned by PayPal, and Cash App, owned by Square. So now in Cash App, you can get your paycheck. You can pay with through Cash App's debit card. You can buy and sell stocks. You can buy and sell crypto. You can get capital. You can get loans. Those are the traditional purviews of banks, or many of them are. I know crypto's sort of new and not allowed in many banks. So what we see is these digital wallets usurping many of the roles that banks play. So we're very cautious on traditional banks, again, depending on the regulatory environment, and very optimistic, especially hearing these cost of customer acquisition numbers. At the same time, the average revenue per user of these networks is rising. That's a powerful combination. We were delighted when MSCI selected us. I met MSCI when I attended an ETF confab, and one of the senior directors of the firm at the confab heard what we were doing in the innovation space. And what she had seen in the ETF space generally was a little bit of spaghetti thrown up against the wall in terms of the ETFs coming out and focusing on innovation. Many people, I think, are very surprised that the two of us are collaborating, because for years I've said, trying to get people to listen to our story, look, the broad-based indexes are great when it comes to tried and true investment strategies. But the world is changing so rapidly. We have to have an innovation strategy.
Christine, MSCI are global leaders in index construction. So the idea of creating indexes on innovation themes really showcases how progressive MSCI is and has always been when advancing the indexing universe. Thematics and innovation investing were once kind of thought of as niche, but with a market leader like MSCI stepping into the space, it shows that thematics are becoming so much more mainstream. I can imagine, Christine, it's been quite a journey for MSCI to get to this point with your innovation indexes. So can you walk us through what led you to look at thematic investing with mega trends and innovations?
When we were out there looking at this space, we thought about thematic investing. So what is thematic investing? It is a top-down investment approach designed to reflect or capture those long-term, structural, truly transformative trends. So these could be macroeconomic, they can be technological. And, ultimately, they're forward-looking. Reflects that, trying to reflect that tomorrow is going to look very different than the past and even today. So we were watching these themes and innovation, especially disruptive innovation companies in the market. And as they started to unfold, more and more of our clients came to us asking us about themes. And so, they were looking to us for solutions. So in 2018, we launched our first set of rules-based thematic indexes to the market. And then there was much interest and a lot of research and demand for us to, quickly add to that initial launch. So today we have about 20 standard thematic indexes under this rules-based methodology. There are a lot of customs and combinations as well. And these 20 standard include 5 indexes that were developed in collaboration with ARK Invest that focus on innovation and disruptive innovation. The MSCI, ARK Invest, and BMO combination is incredibly powerful, and so we could not be more excited about it and seeing it all come alive in the markets.
BMO's innovation ETFs are a terrific way to add innovation to your portfolio. There was a lot of fascinating information in this session about genomics, fintech, next generation internet, and autonomous technology. And BMO has an ETF which covers each of these themes. Or if you want exposure to all 4 of these innovation platforms, we have you covered. We have the BMO MSCI Innovation ETF, which has an equal exposure to all 4 of these emerging themes, which you can access in a single trade. Our 5 innovation ETFs offer liquidity, diversity, ease of use, and are cost efficient and really maximize exposure to each trend. I'd like to thank Kathy and Christine for talking to us today about investing in innovation. And for more information on BMO Innovation ETFs, check out bmogam.com/megatrends.
Wow. So thanks very much, Danielle. That was terrific. So now we can kind of dig into the subject matter and really give our viewers tonight a couple of ideas. I do want to remind everybody that education is a big part of this, and so while I'm very comfortable saying what I do is investment advice, Danielle wants to be pretty clear that if you have questions about BMO ETFs or indexes, that she can provide answers around that. But if you're looking for market opinions, I'll give you my spin on what those are. So I think and I hope that covers us off for the compliance oversight that often accompanies things like this. So here's a chart here that I had pulled, Danielle, from one of your research decks that you had gone through, and it's something to talk about the robotic and AI space and the rapid advance in terms of automation. And there's been a fear that automation's going to take over jobs, and so Kathy doesn't think that that's going to be the case. But when you look at a graphic like this and you look at the curve starting to go like that, you do have to ask questions, but you also see the tremendous growth potential that's coming.
Yeah, exactly, Larry. So I guess one of the common themes we'll be talking about through all the innovation platforms tonight is that rapid advancement and these technologically enabled innovations that are just accelerating in growth. This is a really good example of that. So what we're looking at here is, in the past, what took 25 years in the manufacturing industry could now just happen within 5 years as the economy transitions towards more automation, using more robotics. And I'll note that automation, it's just not affecting factories anymore. It's not just the assembly lines, right? Automation, machine learning, AI, it's impacting all sectors across the board. That's what makes it a mega trend or such a large scale innovation. And if you think about, you mentioned the jobs, so jobs that are being displaced, for example, Kathy predicts driverless taxi fleets. So those Uber drivers will be displaced, or drone delivery. Jobs will open up somewhere else. And this is something that ARC talks about often. So instead of someone delivering my Amazon purchase, and if a drone does that, well, there'll be probably drone pilots that are operating those. And there'll be software designers working on the drone technology in the background. So even though it's displacing the jobs we kind of think about in the past, it's creating new jobs in the future. Again, so this chart just showing the robot density per 10,000 employees. The time that this is taking to happen is shrinking. So it took 25 years for the US manufacturing robot density to hit about 200 per 10,000 employees. And according to ARC's prediction, it could take just 5 years now with that rapid shift to automation.
Yeah, so this adds to productivity, which adds to organic growth, because one of the definitions of growth, the economic growth, is the output that your workforce has per unit of labor. But I would challenge that argument that yes, a lot of jobs are going to be wiped out, but I'm not thinking as many jobs are going to come back. They will be different jobs, though. I encouraged all my 3 kids to learn to be coders. Not that everyone needs to be a coder in the future, but certainly when you look at where some of the job growth is coming from, you know, that is one of the major areas. So, you know, we've got a graphic here, and I thought this was really interesting, where you kind of look back and you say, well, what was the leadership? And even within the rates of change being quick, there's changes within the rate of change, right? There's different leaders coming to the front, and so we can look at the last 9 years here in the graphic and see what some of the leaders are, and then look at even the last few months, and you know, you get a couple new names coming into the leadership category. So, you know, it's pretty exciting from that perspective, and it's actually quite mind-boggling in terms of keeping up with it all. So what are some of the ways that people can keep up with the rapid change?
Right, okay, so what we're looking at here is a snapshot of the MSCI Autonomous Tech and Industrial Innovation Index. So this is a rules-based index that BMO uses for our ZAUT ETF, which is our Autonomous Tech Index ETF. So when you're talking about that rapid change in leadership, an index approach like this, which has a much larger portfolio of stocks than something like an ARC product, which they're very active managers. Those portfolios are about 50 or 40 stocks, high conviction ideas. When you kind of look to something like an index approach, you're really getting access to the entire theme. So you're maximizing that exposure to the theme, you're minimizing that stock specific exposure, and you're able to get exposure to the leaders as they kind of shift and evolve over time, and as they all kind of pull together in growth as the innovation matures. And one really great idea that we kind of saw play out, or example that we saw play out this year, was with auto manufacturers. So of course, Tesla has been the largest holding in the index. Here it's about 6%. And then if you look at ARC, we know they're very bullish on Tesla. It's a large holding in several of their portfolios. But much larger than this. I think they're about 12% in ARKK right now in Tesla, and they have no traditional auto manufacturers in their portfolio. Well, with the index approach, this rules-based methodology is actually identifying a lot of the traditional auto manufacturers as being innovative companies, because they're actually increasing their spending on things like EVs. You know, Ford just announced they're going to open the largest EV factory in the US, and that's really supported its share price. GM is one of the largest investors in autonomous technology, having purchased Cruise for $1 billion, I think, a few years ago. They're leaders in the autonomous driver space. And those companies have actually been performing very well this year. So again, just kind of different approaches to looking at portfolio construction, but with that index approach, you are really getting exposure, maximizing exposure to the theme.
So is this index rebalancing once a year, quarterly? How is that done to keep up with the newest names that are coming into the space?
Yeah, it's a semi-annual rebalance, and then there's a reconstitution once a year. So the reconstitution happened in May, so that's when new names are added and or deleted, and then it's rebalanced semi-annually. So those stocks will then just adjust their weight. So we did see again that example, those kind of old school auto manufacturers get added into the index this year, which when I was looking at the add deletes in the spring kind of surprised me, but as I dug a little deeper, it made sense. So the index does look at how innovative a company is. MSCI attributes a relevant score to each company. It might sound a bit complicated. I'll leave that to MSCI, but what they really look at is how much of a company's revenues is attributed to that specific innovation. And then there's a bit of a market cap awareness as well.
Yeah, I had seen one index when I was looking at, I can't remember what space it was. It may have been uranium. It may have been another one. And I looked at it and I go, why is GE in there, right? And it might have been 1% of their revenue attributed to that space. And so what are the thresholds here? Is it 5%, 10% before a company might be included? Do you know any of those metrics?
I leave that to MSCI. A lot of that's proprietary to them. So, but we do communicate closely. I do get to see kind of what they're adding, how they're deleting. The relevant score is a bit of a calculation. They kind of dig deep into balance sheets. They actually use some AI to kind of word search for innovative kind of buzzwords in the company's balance sheets or in their financial statements to really pull out the true innovative companies that they believe should be in the index. And then, of course, there is that market cap awareness as well. So there's a market cap skew to these indexes, whereas ARC, who are active managers, are market cap agnostic. So they actually have more of a skew at times to small and mid cap companies.
Okay, so there's a lot of different ways to play it. Last year, through our whole series, I brought up the ARC ETFs. BMO hadn't launched any ETFs, last year. I think it was mid-January or so when BMO this year launched their ETFs. So I put together a little graphic here of 3 of the ways. So last year I'd been recommending, the ARQ and the Robo as ways to get exposure to robotics, artificial intelligence, either by way of a passive strategy, which Robo is more of an indexing type strategy, where ARC is an active component where they're making, adds and deletes. And I think they're one of the best in terms of transparency. I think investors can go to their website and sign up, and you get an email every night on the securities that they've added and taken away from their various portfolios. So, I don't know too many people. I mean, I'm a pretty transparent guy, but I don't know too many people that tell you on a daily basis what they're doing. I'm not entirely sure that's a good thing, but it is by way of transparency very interesting. So, not trying to say one is better than the other here, but year to date in these 3 areas, you can see that the more passive approach that MSCI and BMO have taken has actually done a little bit better than what we see in the other robo. There's probably close to a dozen ETFs now that kind of get into this space now, compared to the active strategy in ARQ that's actually been underperforming this year. Again, not to speak poorly on ARC, because I think very innovative, but active this year just isn't beating the more passive approach. Do you have any thoughts on what investors should do? I'm getting some questions here already on the chat. People saying, well, how much should I put in my portfolio if I'm 20, 30, 40, 50? And that really is an individual question, Danielle. I'm not going to ask you to answer that one. I can give some color there, but your thoughts on the different ways to play it.
Yeah, so I kind of dug a little bit on the performance here. I didn't pull a full attribution report, but this just goes back to that active strategy that ARC employs with a very highly concentrated portfolio. So when I look today, they have 38 holdings in ARKQ. Tesla is 12%, Their second largest holding is UiPath, which is an American global software company for robotic processes and automation. Those two names make up almost 20% of the ETF. And so a very concentrated portfolio, just a few names can make or break performance. And now we all saw ARC have spectacular performance in 2020. A lot of that was a big bet on Tesla, right? And Tesla's share price had a gangbusters year last year. So when you look to these active strategies and you look to these concentrated portfolios, you're taking on more stock-specific risk because those active managers are making those big bets for you. And then, the fee is a bit higher, right? So you see like a 75 basis points management fee on an ARC product, which I think is still fairly competitive, but you're paying for that expertise because you think Kathy, or you would think that Kathy and her analysts, are doing their job researching these stocks, and their best ideas are going to make it. And then on the other hand, you can look at something like an index approach, like BMO's approach, with that more kind of top-down, maximizing exposure to the theme, and then minimizing that stock-specific risk.
Yeah. So yeah, finish your thought there, please.
Well, I was just going to say that's how you kind of look at the stock chart now. And again, I was kind of speaking earlier to a couple of the traditional auto manufacturers that have had really, really strong performance this year. And maybe, a couple bit of value tailwinds coming through on ZAUT, which that's not part of the index makeup, but that's kind of what it looks like now. That could be helping that out over 2021. But it just depends on if ARKQ is picking the stocks. If they're winners that year or that month, it'll drive performance.
The passive approach also doesn't take a time frame where Kathy, it seems in her research, is looking 5 to 10 years to try to pick the winners that are going to be the long-term winners as opposed to the shorter term. But so going back to the question that came in, how much should you have? So some of the things that Danielle had said here is the active is going to be more volatile than the passive. Not always, but probably typically because of that single company concentration. The less diversified you are, the more volatility you tend to have in portfolios. That's one aspect you should think of. So as an individual, how much volatility are you comfortable with? And that could be the most important characteristic. Size-wise, listen, should a ZINN that incorporates all these new technologies we're going to talk about tonight, including genomics and including Fintech, blockchain, should that be a broad 50% for a young person? Listen, these companies, many of them that don't make any money, so dinosaurs like me, don't get them sometimes. How do you put a value on that? What I can tell you with certainty and fact and long-term history is that when the liquidity dries up, companies that don't make money get taken out to the woodshed for a little while. It could be weeks, months. And so that's why there's more volatility in what they call these long duration assets. Long duration meaning there's no distribution, you don't get a cash flow out of them, there's little or no earnings, and so it becomes an asset that's 5, 10, 20 years. Is it a bubble? I'd be willing to bet if we look through a lot of these ETFs, not unlike 20 plus years ago, many of these companies may not be around in 5 or 10 years, right? So that's one of the challenges. Therefore, should it be 50% of your portfolio? Probably not, right? Should you have a lot of blue chips, broad exposure, S&P 500 that adds some of these names to it? Yeah, absolutely. So there's no right number there. So as we, how do we go about it? So you can do the ETF way, or you can try to pick some of the winners yourself. And many of our followers on BNN like to dig into individual names. So I looked at what was coming up on the leaderboard on that graphic that you had showed up, and ServiceNow is one of these companies that is an up-and-comer last few years. And if we look at some of the fundamentals here that, again, I like to look at, we can see the trend of revenue growth and earnings growth. and we can see, you know, what the analyst consensus is for a stock like this. And so, you know, from my lens, here's a company that does make money, but when you look at what the PE is, you can, I don't know, can you see it on this? Actually, I probably don't have it on here, but the last price is $670 in terms of when I made this copy, probably today or yesterday. And next year, they're going to earn $7.22. So quick math, about 100 multiple, right, on looking forward. So that's a relatively expensive stock. If you look at the growth patterns of revenue, you can see that it's actually not really accelerating anymore. It is rising still at a pretty straight clip. So there is a risk in a stock like this that you can see periods of multiple contraction. So when we look at it, I say this: don't buy now, but buy now. And so I'm having a little fun with it, if you think about it. But you know, I would have been, if this was in my universe of names, and you know, we're looking at launching a growth fund next year that picks single stocks. Not that I think I can be Cathie Wood, but I can look at a lot of the names that'll be in a passive index like yours. Look at a lot of the names that Cathie Wood does excellent research on, and put my flavor on it. And my flavor on is being a bit of a trader. So I would look at a stock like this and saying, hey, it's reached the analyst target or pretty darn close. Earnings are coming up. It's at the top end of a long-term uptrend. The risk reward isn't as good here. And I would look at it and say, not now, right? But we get a pullback and we get a correction back to trend or the bottom of the range, where now I have a lot more upside potential to a forward-looking price target. That to me is more attractive. So I look at it from the lens of when I went to school and learned about income statements and balance sheets and free cash flow to the new type of analysts. I know you've interviewed a lot of the analysts that do the work in these names. They look at it very differently. Can you give us some comments versus how I would kind of look at it versus how one of these newfangled tech analysts look at these and put a value on these companies?
Sure. So I think that one of the biggest things is earnings. There's a big kind of discrepancy there with fundamental investors like yourself versus a thematic analyst like somebody at ARC who is looking at the market so differently than a fundamental analyst would. So earnings, they, well, actually, Cathie, I've heard her say this, they look for companies who are aggressively investing in innovation. So, I mean, I'm not an analyst there. I don't know what their day-to-day looks like, what they're looking at, but I do know that they're looking in the companies who are aggressively investing in these innovations, investing in these technologies. Their R&D expenses are higher, their patent values, so things like that mean a lot to these analysts. And they're looking cross-sector, and you heard Cathie speak to it earlier in the video, that sector-specific analysts who are just kind of siloed and looking at a specific sector might miss some nuances. Again, healthcare was an example when robotics is going to have such a large play in the healthcare space when you think about surgeries and the integration of AI and robotics there. Tesla, of course, another popular example where a traditional consumer analyst might just not be seeing the value because they're looking at Tesla's revenues on a per car basis. But Cathie would say, well, I'm looking at the value in their AI chip that they've developed, that they're miles ahead of other auto manufacturers. I'm looking at their cloud services and their software development that they have that traditional auto manufacturers just haven't developed or haven't invested in yet. Their battery investment is cheaper, and they figured out a way to make their batteries way more cost efficient, which is another huge thing for ARC. They're always looking at that cost curve decline because, you know, Cathie has, her background is in economics. So a lot of what the ARC analysts do is they have that economic kind of macro look at things before they dive deep into the companies.
Right, very interesting. So here's another name that was on the leaderboard, and an up and comer, and this is a Japanese company, I believe, FENG, who's been around for a long time in terms of robotics. And this is one where I'm looking at it on my charts basis, and I'm saying that, hey, I over the last few years, this has had a run up, but it peaked about almost a year ago. It's missed a little on earnings. It's starting to underperform, but now it's back to trend. And so my thinking and the way I look at this is say, I've got upside potential to the analyst target. And so I like to see that in a stock. The analyst target here is in the $25 range, and we're currently trading a little under 20. It's been underperforming for the last year, and that's okay. But generally speaking, this is an up and comer name. And again, I don't like to buy it when it's rich and expensive at the top end of the range, but when it's back to trend or undervalued, you have to like it fundamentally. So I think you do have to combine the best of both worlds. You have to think about those long-term themes. You have to think about, is this company a disruptor and an innovator? And by definition, being in one of these ETFs, it meets that requirement. And if the active managers of the world, like a Cathie Wood, are using it in their portfolios, this is probably a name you want to own. But I think it's time frame. And so when you get into the individual names, when Cathie's thinking about 5 or 10 years down the road, and you're a volatility, like it's a problem for you, you have to be a bit more of a trader, or you have to buy it really well. And buying a stock really well typically is not buying it at the high end of the range or when it's very overbought. Technically, it's buying it on a pullback to test a breakout point, and the risk reward is just more compelling from the perspective of buy and hold for a number of years. And you get all kinds of people asking questions. Larry, would you buy now? And how much would you buy? And those answers are very people specific. There's no right or wrong there. So, I just wanted to add that color here as we go through some of these names and drill into some of these ideas. So you've talked a little bit about this already tonight, autonomous driving being a theme, and you mentioned Tesla. You didn't talk about Alphabet or Baidu, but I was shocked to see Baidu on the list. I had no idea that they were into this space as well. I knew Alphabet and Waymo was there, and I knew GM has made a commitment to not only be all battery by 2030 or something like that, but their investment also in Cruise. So, for me, I'm actually playing it because I'm a more conservative, traditional guy with GM versus Tesla, where I don't understand how to put a value on it. I know how to trade it, but I don't know how to put a value on it. And when the emotional quotient in a stock is really high, and I would argue that the speculative element in a Tesla is really high, especially with their brilliant CEO, who's now the richest man in the world, or was until he tweeted about selling some stock a few days ago. Do you want to talk a little bit more about this area?
Yeah, so I was speaking with Tasha Keeney, who is one of the lead analysts on the autonomous tech side at ARK, and she kind of talked me through some of this data, which I found very interesting. So when you're looking at the autonomous tech angle, so of course Tesla's exposed to so many different types of innovation, but from this perspective, there's different ways of looking at the technology or the innovation that's going to push driverless vehicles forward. And at this point, we don't know which of those technologies is going to be the winner, if they're all going to kind of coexist, or if it'll be a winner take all scenario. But ARK does a good way of kind of showing it here. So there's camera-based technology. This is what Tesla has been investing in. So this is where there is actually a camera on the vehicle that has to decide how close or how far things are from it. This is a more difficult technology to develop. because if you think about a camera telling me how far away the next car is or the stop sign, it's a more difficult technology to develop. However, it's much more scalable. So what GM has invested in and what Waymo has invested in, these are called LiDAR technologies. So it's actually sensors or lasers that can pinpoint in with much more accuracy how close or how far objects are. So this LiDAR technology is more accurate, it's more precise, but it's much less scalable because these cars can really learn their environment, they can learn their neighborhood, or they can learn their cities, but it would be very difficult to take that car out of, let's say, Toronto and put it in Vancouver. It would have to learn that city all over again. Whereas Tesla's approach, the camera-based approach, the car can be much more compatible across different neighborhoods and different cities. So just a couple different ways of looking at technology. And then the V2X is Baidu. Well, it's Apollo by Baidu. This is a vehicle to infrastructure technology. So it is also much less scalable because it requires investment from governments. So what they're actually doing in local communities or local neighborhoods, they're installing sensors in the road and in objects, and then those sensors are speaking to the car as the car's on the road. So that's just another kind of idea or another technology that's pushing autonomous cars forward.
Right. It seems like a combination of camera and LiDAR might be the solution, and who knows what next new technology, but there was a big M&A deal in the LiDAR space earlier this week. So certainly something to keep on your LiDAR, not radar. Play on words. So how am I playing it? So I played it by way of GM. Like I've got 7 car names in my universe. GM, one of them. I've got Volkswagen in there. Tesla's in there. I've never owned it. Again, I don't understand the valuation. I've tried to short it a few times, but that hasn't been overly successful for me. But you know, I look at the chart here of GM, and I'm saying, well, this sings to me. I understand what it is, and so, you know, I added GM to the portfolio. I didn't have it in June. I didn't have it in February. I didn't have it in April. But as it hit the bottom of its upward sloping trend channel in September, it started to talk to me. We had got some bad news on earnings kind of out of the way. There was the computer chip thing, and so a lot of bad news got priced in. So here's where the time frames start to make a lot of sense for me. In that they're in the space, they're a leader in the space because they're in this group of companies in these indexes, and they're very visibly green. They want to move to the new version of what cars will be in the future and so forth, but I want to buy them at the right time. So I bought GM in September. It had a very strong run up initially. We were heading into earnings. The last earnings missed. We're now at resistance on the stock. And then I looked at Volkswagen and I said, they haven't moved yet. And I sold my GM and I bought my Volkswagen. And sure enough, GM started to pull back. Volkswagen had some good news. Boom, they rallied 10%. I sold out my Volkswagen, and on the dip in GM, I got back in. So I don't think about buy and hold for the next number of years. When we're active in our stock portfolios, I say, here are the names fundamentally that I would own. Again, Tesla's in there and NIO is in there, but I don't get the valuation side, but maybe I will in a year from now, who knows? But they're in that group of companies. And so that's kind of how I do it. I like to look for the upside target. I like a lot of intrinsic value in my portfolio. Now, make no mistake, the analysts are not always right. In fact, they're wrong a lot about what the stock might be worth in the future. But I'm just giving you some color here on how I play these and how I'm looking at these new names. And you know, GM by any stretch of the imagination isn't a new disruptive tech company. So it underscores that a lot of these, you know, old type companies can still be thought of in the innovation space, as long as they are moving in that direction. So, question had come up: is there any sectors that we need to be on the radar to watch for the future? And as I was looking through your notes, Danielle, I came across this chart. And do you want to speak to this sector?
Sure. So we're talking about drones here. So advancements in battery cost decline and the advancements in autonomous tech are actually making drones possible for commercial platforms. One of the largest platforms or purposes being home deliveries. Now, drones are actually more heavily regulated than vehicles are, and that's because they're flying in the air above our heads. So of course they're facing more regulation. However, we actually are seeing this regulation moving. We're seeing it in the US, we're seeing it in Canada. There is a growing amount of commercial pilots actually out there already. So the technology is here, but it's really now with drones about scaling it and then getting those regulatory approvals. So this is something else I pulled from ARC's Big Ideas report. So ARC's prediction, and with their analysis, they think drones could deliver over half of all e-commerce deliveries within the next 10 years. So that's not very far away. And then this is really an area where you can see that convenience and that cost impact, which really matters to the consumer. So we haven't really touched on this yet, but when we're thinking about these innovations, what makes something an innovation and something that's not an innovation? Well, the convenience, problem solving, making things cheaper, doing things faster. So drones are going to solve a lot of those problems for us. They'll make things safer. There's safety benefits. So if you think about less vehicles on the road with less, drivers delivering things to us, that has that kind of added benefit as well. So within ARC's predictions, they believe that drone delivery platforms could generate 275 billion in delivery revenues. So think about that. That is a huge number. Then 50 billion in hardware sales. And then that would be supported by software infrastructure. So an example of that would be mapping revenues, which they're predicting to be at about 12 billion. So drones are just I think they're really exciting because of that lowering costs for consumers and then increasing convenience for us.
Pizza delivers your drone. Do you tip it?
Yeah, no, the cost goes down unless you tip the pilot. That's a good one though.
Well, I guess would there be a pilot, or it would be like autopilot, or someone's kind of watching the camera?
Maybe. I actually don't know how all the nitty gritty of it, but it is exciting. Might have a burrito delivered to me by a drone within the next 10 years. Pretty cool.
Oh, that would be great. I go out every Monday after my show to get a burrito. It's my naked chicken burrito is my favorite. Okay, so let's get into the next area here, which is genetics and DNA sequencing. When I was a younger version of myself as a strategist for CIBC, I was on a trip in Boston, institutional trip, and I remember the announcement of the decoding of the DNA. And I believe Kathy mentioned it was 2003. I think that's about the right timing that I recall. And there was a stock, I can't remember the name, but it was up like 50% that day. And I thought to myself this, and then I shortly after that, I had my annual physical with my doctor. And he said, Larry, maybe not you, but certainly your kids are going to live to 120 because they're going to be able to regrow organs and all these things. And so now, 20 years on, I think about this stuff when we sit down with our clients, and many of the people on the call here might be 60 plus. And you think about retiring soon, but now you're going to live for another 30 or 40 or 50 years. And that money that you've saved needs to last for an awful long time. So there's a lot of great things coming, but this is going to present a big challenge for the investment industry. So the next topic, we'll get into fintech. But let's first talk about genetics here and the different areas of healthcare. I know BMO has a broader healthcare, way to play healthcare by way of ETF, but I really want to focus on the newer innovations in the DNA sequencing here.
Yeah, so when we're talking about genomic innovation, so this is a different way of looking at the market than looking at a pure play healthcare sector. So pure play healthcare sector, obviously you're looking at things, yes, you have biotech in there, but you're also looking at things like equipment or healthcare services or the facilities. And then when we're looking at genomic innovation, what we're really truly looking at is all the companies that are investing in developing therapies or developing, different types of things that are based on the back of that sequencing of the human genome. So you said you remember when it happened. You're right, it happened in 2003. And just to kind of give you a sense of how far we've come, it cost $2.7 billion and 13 years of computing power for that first ever human genome sequencing. So today, it costs $500 and just a couple hours of computing power. So I think that is a really powerful example of showing you now today, I don't know what stock you said went up 50% in 2003, but maybe doesn't exist anymore. Maybe it jumped on the notion of what we'd be able to do in 20 years, but it just wasn't possible back in 2003 because of the cost it would take to sequence a human genome. So now just a few $100s, we're really getting somewhere, and these companies are really developing a lot of advancements. CRISPR-Cas9 is something that there's therapies that are actually looking at editing mutations in a genome. So whatever mutation is in there, that mutation is a precursor for disease. So with these Cas9 technologies, they're actually looking at editing out that mutation. And this is on the path to cures. So this is something Kathy said, we've never faced cures before. So if you think about then the economic value attached to cures, and these are the companies that will be holding those patents and that are investing in that technologies. It's just a very powerful concept to think where these companies could be that now in the next 20 years from where we are now.
Oh no, without a doubt, and it's an extremely exciting area. But if I can draw an analogy, I remember sitting on the trading desk, and it was probably late '99, early 2000, and Ballard Power was a Canadian hydrogen play, and they were going to have this solution for batteries and clean tech, and here we are 20 years later, and not a lot of movement. So you do have to be careful, I think, when we think about some of these. And from an investment standpoint, what are you paying for today? And how long is that cycle? Because you're going to get excitement. You're going to get a lot of emotion in the idea. A stock jumps 50% in one day. And then you're going to get a realization that the earnings coming from this may take an awful long time. And Kathy talked about billions, if not trillions, of revenues coming from some of these cures for many of the things. I think we've seen a little hint of this on how quickly through mRNA we were able to get vaccines. So tremendously exciting in how they're doing a lot of these things.
Yeah, I think mRNA vaccines is a great example. It's a technology I had never heard of prior to 2020, but going back to that sequencing of the genome, the COVID was actually sequenced in January of 2020. So it was sequenced while I was still taking the streetcar to work and still flying on vacation and reading headlines about COVID and not thinking it was the real deal. So that's how quickly we're able to execute these things now. And then the fact that we could, make a vaccine so quickly and inoculate the globe so quickly is just fascinating. And it comes all the way back to genomic innovation.
Yeah, someone's commenting on the cost here, and that is very, very real. I think it was Regeneron that had some cocktail of this and that was going to, but it was maybe $50,000 a month or something like that. So you know, the more money that goes into it, the ultimately the better it is. But do you think this is a sector, and maybe you're not the right person to ask, but it just kind of thought where regulation comes in and they kind of maybe not stifle the investment, but the cost, you know, have to be managed somehow. The biggest inflationary pressure is in the healthcare sector.
Yeah, I'm not as plugged into regulations on these things, but I do know that mRNA vaccines were funded by a lot of governments, a lot of public funding. But I'm less plugged into inflation on that. But I do know that, you know, if you want to look here, actually, at this chart, again, kind of coming back to importance of cost declines. So what this is kind of telling us is the dollar invested in R&D, what these companies got out of that, and you can kind of see it flat lines or almost drops. But then ARC is kind of saying that actually now they think that every dollar of R&D expense invested in new genomic technologies is actually going to become so much more valuable, because these are now going to be curative therapies, and the value that these companies will get for these cures and for these types of therapies will just be so much more valuable than treatments were in the past.
Yeah, a lot of people have written in and asked about my weight loss and if I was healthy or not. And it's been a very healthy weight loss. But again, anecdotally here, my whole adult life, when I was what I would say on the heavy end of my range, I would have been maybe 240 pounds. And on the low end of my range, maybe 215 pounds. But I went to a doctor, a specialist at one of the clinics here in Toronto, and he got me on a program where it was part psychology and understanding the behavior around eating, and the other part was getting on a trial for a drug they were testing, which has been around for a long time, for treatment of blood sugars, high blood sugars. And I was a category, I was pre-diabetic, and it was all, the doctor was always lose weight, lose weight, lose weight. Well, so now I'm 185 pounds. So I've lost 50 pounds from my recent peak. And I think the last time I was this weight, I was probably 12 years old. So it's been a game changer for me. And the benefits of not being high risk to heart attack, stroke, all these other aspects. So the cost of this drug, though, is not cheap, right? And so because I was on the medical treatment for sugar, I was able to use it. And so now this drug has been approved as a weight loss drug. And one of the insurance companies are debating whether they should pay for this, because the thought of obesity is that it's not a sickness, when in fact we know it is. For a lot of people, it can't be controlled. It's not a willpower thing. It is a genetic issue that people have. And so, you know, again, maybe subject for another debate, and I understand you're not the expert on this and what I'm commenting on here, but it relates to the costs. And you know, I would go pay, and my plan covers 90%, and it would cost me about $50 a month with 90% coverage. But can you imagine if you didn't have that? And so how can an average person afford thousands and thousands of dollars a year for some of these treatments? Whether and may very well be life-saving and certainly life-extending. So this is an area where investment is going to be super critical, you know, and I think there's no shortage of money we can't put into this, and I think we do need a lot of government support for it. The internet was born out of investment from the government, right, in the space program and so forth. So I think the government has to be an important partner here. As much as we complain about government expenses, some of these things are great investments. So when we look at different ways to play the genome space, there's the active and there's the passive, and not saying one's better than the other, but when we look at the indexes here, and I took these snapshots probably earlier today, you know, you can see that in Kathy's approach, I know Teladoc's one of the names that she loves, and this is, you know, where I think one of the things in the video she mentioned was where healthcare guys don't understand technology and technology guys don't understand healthcare, and this kind of marries them up together. It's her biggest pick in the index compared to the market cap weight of playing it, where the ones that have done better recently come to the top of the leaderboard. And Moderna is up there. Why? Well, you know, we know why, because they were second to market with a effective vaccine. Is Moderna and mRNA going to be always up there, or is this something, again, I'm not asking you to opine on the outlook for Moderna here, but this is where active and passive, some areas, and I think genomics might be one of them, where it might make more sense to go with an active approach than a passive approach. Do you have any thoughts around these sectors and which one might be better than the other?
I can't say one is better than the other, but you know, it's kind of the same story here. So you can go the passive approach, which it's not just market cap. Remember, we're also looking at a relevance score. So Moderna has one product right now in the market. It's a COVID-19 vaccine. So they are very relevant in terms of their revenues are all coming from a genomic innovation. Are you surprised you don't see Pfizer in the portfolio? A lot of people ask, well, why isn't Pfizer in there? Well, Pfizer is such a large company that its revenues from its COVID-19 vaccine play such a much smaller part in its overall book. And BioNTech, actually, who splits revenues with Pfizer on the vaccine, BioNTech is also a name in ZGen. So when you look at that passive approach, you're looking at companies that are really truly, like I said before, maximizing that exposure to the overall trend, and then minimizing your stock specific risk. Kathy doesn't own Moderna. She might have in the past. Maybe now she thinks the growth is they're finding growth elsewhere, I guess. She really likes Teladoc. You could also view Teladoc as a next generation internet company, right? Because they're a virtual healthcare provider. So I think they hold Teladoc in other portfolios as well. But again, two different ways to look at it. ZGen has about 200 different names. It's rated as medium risk. And then ARC-G has about 60 names rated as medium to high risk. Just a kind of different approaches.
Yeah, it is. The concentration is I can't underscore your comments earlier on the concentration. There's going to be more volatility in those kind of names. So, you know, when you start to dig down then and say, well, you know, what names do you like? CRISPR and the CRISPR technology, the founders of this company, if I'm not mistaken, won the Nobel Prize, was it last year, for their work in this area in gene editing. There's all kinds of social implications. I'm not going to speak to those at all, and is it right or wrong, but this is part of the future of curing disease. But there are other things. So I had warned on a lot of these names as they were getting parabolic a year ago. And if you think CRISPR is going to be a player in the future, Kathy clearly does. And I look at this chart now, I say, now it's starting to get interesting because I'm a value guy and a relative value. And now I see significant upside to price targets where I didn't a year ago. I've seen a number of red bars there. Those red bars, someone had asked, are misses on earnings, where the green bars are wins on earnings, outperforming and beating. The E is kind of the yellow is kind of a neutral to earnings. So that's the Bloomberg coloring scheme there. And so, you know, those are some of the things that I look at for. And again, when we look at where the analysts think this might be worth 12 months, 18 months ahead, you know, 156 is the average. There's a bit of a skew. Some guys really like it, and the guys that really like it think it's probably closer to 180, and the ones that don't like it, meaning they're a hold, are probably around the 130, 140 range. So, you know, that's kind of the average target. But right here, south of 100, it starts to look interesting. That being said, where's the technical support? And you would have to look at the lows from 19 and 2020 and say this stock could fall below 50 before the chart would say there's really good support there. I don't know what's going to happen here. So again, for me, it's a name I like. I don't own it today, but it's now come on my radar as something that I would potentially put into my stock portfolio at this point. So just again, a thought for everybody out there. Next gen internet, passive or active. So again, here's another look at the current universe of these two ETFs. So the BMO index version, ZINT, and the ARKW. Can you give us some thoughts on these two?
Sure. So maybe I'll just quickly give an overview of what's next generation internet. What does that mean? So you're looking at sub themes like cloud computing. I know you mentioned ServiceNow earlier. They're heavily invested in cloud computing. Cybersecurity. You're looking at companies that are creating semiconductors. This is a very important input for these types of technologies. The gaming space, the more I've read about it, has completely shocked me. This industry that I know nothing about, that I don't partake in. The VR and AR kind of virtual reality, augmented reality investments made in that space. You just heard Facebook come out, now they're Meta, and they're going to be investing in the metaverse. Like this is real, this is happening. Companies are investing a lot of capital into seeing these technologies move forward. I spoke to the analyst.
I think it's a colossal waste of time, but it's just me being a dinosaur, I guess.
Right. I'm not a gamer, but if when you start talking to these analysts, I'm speaking to the analyst at ARK, and he's telling me, okay, well, gaming is actually a very social thing. People are using video games, they're connecting, they're socializing, interacting on these platforms. This is a completely growing trend. They see the VR, AR space pushing the needle or pushing this forward, where our phones and our computers, if you can believe this, Larry, are no longer going to be what we use to interact with the internet. We're going to be using AR goggles and VR to be interacting with the metaverse. So that's kind of where they see it. If you want to put some numbers to that, so the gaming business now is 175 billion annually in sales. And that's virtual goods and physical gaming devices. And then just to put that into perspective, that's more than if you look at movie entertainment, TV entertainment, and music entertainment combined. So that's, I think, kind of a phenomenal number. And then the way they're monetizing gaming is completely changed. When I was growing up, you pay for your N64, and then you go pay for the game, your 1080 snowboarding or Mario Kart, whatever. Now people are using their phones, so they're not paying for the actual devices, but it's all in-game revenues that are just opening up a huge new revenue stream for these gaming industries.
I grew up in a pool hall, and it was Space Invaders and pinball machines. So I guess every generation had as their way of socializing in that regard. And I paid for my university playing poker. So that's a whole other thing. So looking at sort of this and giving an idea here, when we look at what the stock is here, this is Alibaba, and so when we look into the internet and new technologies and new ways of distributing retail, I look at Alibaba and I say, well, it's China's Amazon. And we know there's issues in China. A lot of people have said it's not investable right now. There's 2 months uncertainty. I'm looking at that as a lot of noise. China wants to be the biggest economy in the world, and the main way they're going to do it is with open economies and open markets, not with closed systems. Now, Xi is serious about inequality issues, and China has inequality issues just like the US, and he's trying to address them with the policy tools they have, where I believe in the US it's about taxing the rich and wealth taxes. They're both doing it, they're just doing it different. I think you can look through it, But a stock like Alibaba, to me, is a huge buy right now. If you like what they're doing and you think they're, going to be the same type of distribution channel as an Amazon, I think you got to like them right now. Relative potential upside just looks very, very attractive. So these are the kind of things that I look for when I'm looking at the sectors. One of my favorite technical analysts, a guy named Ralph Acampora, I had him on the show years ago. He's semi-retired now, but still going at it in his mid-70s. A guy I met when I did my internship on Wall Street, too many years ago. And he said, Larry, when I made my Dow 10,000 call, I looked at all the individual stocks in the Dow and I said, if all of them together could reach their target at the same time, what would the index be? And then I took half of that and I came up with Dow 10,000. And so when you look at KWEB as an ETF that I talked about to play Chinese internet names, and I look at the big names, and the name Alibaba is one of them, and you look at all the individual charts, a lot of them kind of look like this right now. There are a few names that I wouldn't touch, but generally speaking, it looks very, very interesting to me. So, that this is one way that on an individual stock basis, I'm looking at right now. Let's get into the last part, the last group here, which is the fintech, the blockchains, the cryptos. Danielle, tell us a bit about this sector.
Sure. So Alibaba is a really good segue because they're also, I think, still Alipay. I know they pulled back recently with what's going on in China, but are the largest fintech firm in the world. And they're huge in the fintech space. So when you think about fintech, well, what's fintech? These are the companies that are disrupting the traditional banking industry. So they're offering everything that a traditional bank would offer, but of course now using technology to enable users using things such as digital wallets. And we're seeing this happen actually globally. And actually, if you just want to move on to the next slide, what I wanted to touch on, which I found really interesting with my research and reading up on the fintech space, because you were speaking about China. You really need to look global. This is our perspective at BMO when we're looking at innovation. ARC does that as well. But you want to look global when you're looking for these companies in innovation, because fintech's a great example. If you're not looking at China, you're going to miss out on the biggest players, because WeChat Pay, that's owned by Tencent, and then Alipay, which is owned by Alibaba, are the biggest players in the space. And this is all kind of goes back to China being a very cash-based society. Credit cards didn't take off there. They weren't very big at all, or Interact payments. So the transition to digital wallets was more seamless, or it happened so much quicker, so much faster, because everyone had a phone. So it was very easy to get a digital wallet downloaded, but most people, or many people, didn't have credit cards. So if you kind of look, it's very similar to kind of the banking sector now, where if you look globally, every region kind of has its own fintech company that's kind of emerged as a leader. If you look across the globe, and a lot of these companies that I've never heard of until I started digging deep on this, have significant market caps. Like I was reading about, as an example, in the Netherlands, a big fintech company called Adyen. They're sitting at 86 billion USD market cap, which is very similar to many mid-sized banks. So these are big companies that are continuing to grow and continuing to get kind of market share from traditional banks.
It is exciting. A question that come up here. Now, the BMO ETFs in these areas are relatively new. Someone's asking about how the dividends work. They're all going to have an annual distribution, but is there a plan? Because many of these companies don't pay dividends, but some of them do. How is BMO going to handle the dividend stream?
Yeah, so we'll look at that annually. So we'll look at that at the end of this year. So probably around now, we'll look to see what we're going to pay out. for these growth ETFs. But you said it, Larry. These companies don't pay a lot of dividends, so we'll look at the end of the year and see what we've collected over the year, and then we'll pay it out to shareholders at the end of the year. And we put that on our website. Everything. We even have a press release, so everything will come out within the next month.
Right, and many companies in North America first have quarterly dividend cycles, but internationally semi-annual and sometimes annual, so they tend to be very lumpy. And of
yes,
course,
they'll build up in the fund over time, and then whoever's a unit holder at the end of the year when we pay out, we'll get that. Now remember, there's fees involved with ETFs, so that comes off as well before we pay out any
right. So if the accrued dividend was 30 basis points and the MER is more than that, then there wouldn't be a distribution, right?
Yeah, we look at things like that. Yeah.
Right.
But I haven't, these are new funds. I actually haven't looked at the what we're paying out or what that looks like yet.
Right. Okay. But as I say, again, many of the companies in the index don't have distributions. Obviously, Apple and Microsoft and some of the big mature companies have some, but a lot of the newer ones without income yet aren't paying dividends. Certainly, they're retaining their cash flows to reinvest. Digital wallets, right? So this is an area which is quite fascinating because, basically it took the biggest banks in the U.S. decades to amass the number of companies that some of these mobile wallets have taken only a few years. So you talk about that theme.
Yeah, and what's interesting, Larry, is that it wasn't organic growth. So if you look at this, so it took JP Morgan 30 years to hit the number of users that Cash App and Venmo took 7 to 10 years to get. That's what 60 million users is what we're looking at. It took JP Morgan 5 acquisitions to get there. And then Cash App and Venmo, it was all organic growth. So that's kind of another interesting way to look at this rapid acceleration or this exponential growth rate in this space. And I think it makes sense. It's quite easy for users. We all have phones, so it's quite easy to download an app to set yourself up. You can do it from your bed or from the couch or while eating your burrito on a Monday night. So I think it's making sense why this has become so popular. And then for younger investors or younger users, it's so much easier than walking into a bank branch.
Yeah, I think there's an appeal to it, definitely. I don't have a digital wallet yet, although I guess I have a PayPal account and some of those basic ones. But how different are these than just your regular credit or debit cards? Is it really new? To me, they're kind of the same. They're kind of frictionless payment systems.
Yeah, I think you're right. And I was thinking about this. I'm like, well, I always carry my credit card around, but then often I'll forget my credit card more. I'll forget my credit card more often than I'll forget my phone. So the times that I've been out, I'm like, oh, I forgot my credit card, but I always seem to have my phone. So I think it's just that convenience. It's, again, we're doing everything from our phones now. It's one less thing to carry around. It's one less thing to worry about. And then of course there's all the other, it's not just mobile payments, right? So these fintech firms are offering loans. They have their wealth management arms where you can do your trading and things like that. So they're offering a lot more than just mobile payments.
Right. So once you get the client, you can try to monetize them in other ways, right?
Exactly.
That seems to be the message there. Right.
Yeah, and that's what this is showing. So took this from ARC again because they have such great research. So they see the value coming from the value of each user coming from 2 different places. So each digital wallet user is, according to ARC, their analysis, will be worth roughly $10,000 per average US user. And that will be from financial services revenues. So kind of traditional bank services that we would think about. But then beyond this, ARC sees kind of another avenue for revenue. So they also think that digital wallets could become lead generation platforms for e-commerce, which could potentially add another $10,000 or $10,000 of value per user. So that's kind of how ARC is looking at it right now.
So the 2 ETFs, then the ARC version, again, there are others, but featuring Danielle's expertise tonight and that of ARC's research. We're focusing on them tonight. So looking at these two ETFs, you want to give us some color here, because this is a sector where I do actually see some current value, and I want to drill into a couple of these companies. We are running out of time here. We're going to run over our typical 8:30, so stick with us for a few more minutes here as we wrap up. So Danielle, blockchain fintech ETFs.
Yes. So, and then I'll just say one thing. There are more and more products coming to market. So investors really should do their due diligence and go to providers' websites and see what they're investing in, whether it's fintech or all the other innovation products we're talking about today, because more products are coming to the market, and you want to know exactly that you are investing in a fintech portfolio and not something else. So keep that in mind. ARCF, same story, very concentrated portfolio. It's 40 names. Actively managed. ZFIN on the passive side, the BMO ticker, you have 165 names. Looking at it, just the snapshot right now, because ZFIN is that index approach, we're not making country calls, whereas ARC is making a country call right now. They are pulling out of a lot of their Chinese equities and Chinese investments. That's a call that Kathy wanted to make. That's their active decision. On the index side, we're not looking at it that way, right? We're looking at the companies that are most exposed. So because of that, we still have a 16.5% weight in China. Alibaba is still a top 10 holding. Tencent still in there as well. So it's kind of one difference.
It is clear, very couple of the same names up there on the top list there, but really very different portfolios. So absolutely, you got to look in it and do your homework. But this graphic really shows the difference between active and passive. I think when you're really bullish on the space, active can lead to some upside. But when the sector goes out of favor, active can also, hurt you a little bit here. And you can see the volatility and the difference between the index version that's more diversified and the more concentrated version here. But when we look since BMO launched in January in this space, they're actually down on the year, which to me, again, from a value perspective, I say, there's something there. So this is something that is on my radar now to start nibbling on in the portfolio. Not that it's cheap on an outright basis, but kind of makes sense. So let me drill down here and say, active management. So Zillow, what can go wrong? Well, Zillow started getting away from being a fintech company and started buying homes. And this is where I think when you're doing your work and your research on these individual companies, you got to understand a little bit about what they're doing, because they got in a very bad space and they were overpaying for companies and they got over leveraged. And if you've been following recently, they've been having to panic sell a lot of their names. So, what can go wrong in these spaces? Well, there's all kinds of names in here that have some issues. Coinbase is another one recently that has come into a bit of a gap down situation after a bit of a run up. When we look at PayPal, wow, again, great company, but it's not always buy and hold for a lot of these names. And when you look at why this index is lagging a little bit on the year, recently it's all these payment systems, including Visa, MasterCard, and the like. So the old payment systems, the new payment systems, there's some value building up in the sector now. So, with that, I will ask you, Danielle, for some final comments on this space, and we're pretty much out of time for the night.
Maybe I'll just leave you with one small example for investors that are, thinking about innovation or taking away from tonight's conversation. My favorite example is when you think about BlackBerry. So if you were, 15 or 20 years ago, really bullish on smartphone technology, and you decided to invest in BlackBerry to ride that wave, well, you were right on the emerging theme, but you were wrong on the stock. And I think that's a really kind of an interesting way to approach this type of investing. If it's new to you or it's something you want to learn more about, is thinking about that ETF side. I know I work for an ETF provider, but thinking about that portfolio approach, because you can really maximize that exposure in your portfolio to the trend and then minimize that stock specific risk.
Yes, excellent. Thank you very much, Danielle. I really enjoyed our conversation tonight. This is clearly an area where we've got a lot more to cover in the years to come, and I'm sure we'll have you on again to look at, a year from now what's happened and a lot more of the great things. So as we wish goodbye to everybody, lest we forget, folks, and thank someone who's served for us in this great country of ours. Have a great week, everybody, and we'll see you next week.